The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, as we wrapped up Tuesday's session, another fairly quiet market day overall. Grains and oilseeds, we'll call it mixed to lower. Livestock trade, cattle tried to move higher in the morning, then kind of turned mixed as we wrapped up the session. Hogs were under some pressure. Decent day in the outside markets, but one has to wonder if these markets are going to have another quiet week ahead of the end of the month USDA reports and then all the tariff talk as we get into April. Let's take a look at what's moving in the markets. Joining us now, Ted Seifert with Zaner Ag Hedge. Ted, it's good to catch up with you, buddy. How are you?
Yeah, I'm doing great, Jesse. How are you, man?
You know, I can't complain. Sun is shining here, and I know a lot of folks are thinking about spring planting, spring field work here as we wrap up the month of March. And I wonder if, Ted, that's what the markets are thinking about right now. I'll jump in and just throw this to you. These markets, very quiet. Have to wonder if we're marking time until we get those USDA numbers at the end of the month, which a lot of folks are calling for corn acreage to be pretty stout, and there's even some estimates out there at 95 million or above, Ted.
Oh, yeah, I've seen higher than that for sure. Yeah, that's definitely part of it. We've got some major, and I say some because, yes, acreage, but also quarterly grain stocks is one everybody sleeps on. But, on this particular report, sometimes that is the surprise, that is the dark horse. And then, like you said, I mean, April 2nd is a big, big day on the calendar for, what happens with tariffs and everything like that. And what we've had so far this calendar year, or actually even going back to, after the election, so like November, December, we had very active markets that would normally be pretty quiet in that time frame unless there's a big South American weather issue. We had some of that too, right? So we had South America, we had some normal grain fundamental things that we had to trade, but we also have these bigger, broader picture things, policy, trade relations. There's concern about the domestic economy. There's concern about the global economy. That's sort of an on again, off again thing, right? So like the risk on versus risk off, you had a lot of that. The big move that corn had at the end of February to the downside was funds running away from long positions that I don't think had a whole lot to do with really corn fundamentals. That was just a risk-off move as there's just a ton of uncertainty with what happens with tariffs, what happens with the economy. They just didn't want to have anything to do with it, even though fundamentally I think they wanted to be long corn, or still are long, but only about a third of what they had going into the last 10 days of February or so. So we've had a lot going on. It's a good time frame for the markets to take a little bit of a breather. We haven't had a whole lot of new news last week or this week so far on tariffs and things like that. So no headline shocks, at least yet. And then, like you said, acreage is a big, big thing. And again, that April 2nd is a big, big thing. So we are kind of biding our time, waiting for the next shoe to drop. We know that there are shoes coming, right? So, just kind of treading water here at the moment. And so we'll see. As far as the acreage numbers are concerned, even going back to last November, we've talked about the corn and bean ratio. We've talked about profitability. We've talked about how it looks like corn's going to be a lot more attractive to plant and how we should see a pretty sizable increase in corn acres. And that's reflective of really what the overall fundamentals have been. I mean, if you go back 2 Februarys ago, a little over a year ago, the USDA had started us out on their outlook numbers at a 2.4 something billion bushel carryover, and that's dropped about 1 billion bushels for the old crop corn. That's been a slowly realizing better scenario for corn, both on lower production and on better export, overall demand, but specifically exports. It's really changed the outlook for corn. The bean outlook has changed as well, but not as much, right? And you look at the global numbers for beans, I think we originally were talking about 134 million metric ton carryover globally. Now we're down to, 120 or just under. So that has gotten better, but it's still a 20% increase over the last 2 years. So again, all of that is saying we need more corn acres. What if we don't have a 172 national average yield next year? Or what if we have troubles during the growing season? if we don't have that extra acreage for a cushion, man, we can have a really tight corn balance sheet. And so that's all been reflected in that corn bean spread. It's been reflected in what guys are talking about for intentions. But you do wonder at some point, Jesse, do we really kind of get out of over our skis a little bit? I've heard 97 million acre estimates. That's not the average. That's not what the market, I don't think, is factored in. But man, we've really, I think, insulated the upside for corn of what our expectations might be. So even if it did come up, even if that number comes out above the average trade guess, we might have sort of factored that in already. I don't know. We've not seen the average trade guesses yet. Yeah. I'm part of that. And the three major news agencies have different due dates. The first one's today, another one's tomorrow, another one's Wednesday. So by the end of Wednesday, we'll start at the soonest. I think Tuesday we'll see two of the major news agencies produce their average trade guesses or their survey from the analysts. And then, maybe the third one on Wednesday. So, I don't know, maybe that number does come out at a 190 or a 97 for corn, but I don't think it will. I think it'll be a high 94, low 95, somewhere in there. But again, maybe we've insulated ourselves against a really big number. Maybe we set ourselves up for a bit of a friendly number on that acreage number for corn. That could be negated by stocks, though. So keep an eye on that. Again. Yeah. And then, the opposite for beans, maybe some of the thoughts that we've had on bean acres, maybe it's too low. I don't know. Either way, acreage has been talked about I think longer this year than it normally has. So I don't know if we're going to get any big shocks out of that report. A lot of times we do. This time, I think we have a really good range. And I think for corn, we've insulated ourselves for an upside surprise. And for beans, we might have insulated ourselves for that downside surprise.
I got to think of how I want to put this to you. What could happen for the markets if we get maybe a double whammy of bearishness? Maybe that corn acre number is higher than estimates, and then tariffs come into play later in the week. Do these markets need to be that concerned about the tariffs on April 2nd? Could that be a bit of a double whammy of bearishness for the markets, Ted?
Yeah, I think the reciprocal tariffs are probably the scariest thing that we've done, aside from how we're dealing with China. But as far as, Canada and Mexico and things like that, April 2nd, I think it could be a bad deal. Now, here's the thing. We've been talking about it for a long time. And so to some extent, we've factored that concept in. I think that's part of the reason why we're not really finding any strength at the moment. I think it's part of the reason. You look at Brazilian weather for that second season corn crop, and there's some concerns there, but we've not really expressed that in the market quite yet, because almost it doesn't matter if reciprocal tariffs, but also, if we're going to be charging port charges on any ship that has anything to do with China, oh man, I mean that's going to really limit our exports to China, but not just China, really a lot of places. So I think we've got some concerns about the future. We have some reasons to be optimistic from a weather standpoint. I mean, you look at the longer term forecast for our growing season, and some of your weather guys are very concerned. It's a long ways away. I think it's too early to be really trading that, but that's something that is going on in the back of my mind. So you have pretty dramatic possibilities on both sides of the market: upside from weather, right? Downside from global trade. And again, markets are kind of quiet right now because I don't think they really know which way to go with that, or which prevails, I guess. So I don't know. I think it's going to be very active next few months, both from policy and from weather and all of those things. But when it comes down to it, Jesse, I think this is the moral or the crux of your question. What should we be doing? Right. And I think, given the forecasts that we have, this is a great year to have orders to the upside resting in order to get hit, price targets, right? You got to have those. That didn't really work out that great last year. We never really had that significant weather rally through the growing season. It came late as we kind of realized that, the hot and dry did really cut into our corn and bean yields. But during the growing season, we didn't have those spikes. Now, 2 years ago, we had 3 of those spikes. Mm-hmm. I think it's going to be I think there's a good chance it's going to be closer to what we saw 2 years ago versus last year. So I think there's going to be that upside potential to get, orders done. But in the meantime, you got to really worry about what the downside might be from global trade. So I think ownership of some short to midterm puts is great. Set those price targets, and if you want to, there is that possibility of a bigger drought issue. There is that possibility of sharply higher prices. I think some reownership calls sooner than later might not be a bad idea either, right? So if that's what helps you feel comfortable having those and leaving those price targets in, owning calls so you can pick up any extended rally or participate in something like that. I think it's a great play too, right? But I think this is maybe the worst time to be doing nothing because there's a tremendous amount of risk on both sides of these markets right now.
We are talking with Ted Seifert from Zaner Ag Hedge, joining us here today on Market Talk. Ted, how about that livestock sector? Let's touch on the proteins a little bit. Cattle on feed numbers, the big placements drop. I think that was largely expected, though, by many folks in the trade. And I'll call Monday's action fairly mixed in cattle and hogs. I mean, and I know, too, this protein sector's been fairly tied to the outside market, stocks, the economy, et cetera. I mean, what's your view of the protein sector right now?
Yeah, it was kind of a wild day on Friday for proteins. I mean, feeder cattle had key reversals down, set a new high and then ended up closing below the previous day's low. A lot of technical traders look at that as being an indication of a top, possibly. I don't know if I really subscribe to that. I think for me, when I see a key reversal in a market, that's a big red flag saying, hey, this needs to be watched. This trend might be at risk here. And maybe not the absolute top, but it could be suggesting that we're getting towards the end of a longer term move. And in this case, big bull run. But then we get the cattle on feed report, and fundamentally the driving force has been short supply, and that placements number didn't help anything. We were expecting a low placements number. I think an 86%, came in well below that even. So that was pretty bullish, and then we gapped higher to start the day on Monday. No night session for livestock, so we gapped higher, but then gave it back immediately. Then we spent most of the morning trying to claw back. And then towards the afternoon hours, gave a lot of that back. So, you look at the overall body of work from Friday and Monday, and you say, I don't know, this doesn't act like we just saw a really, really bullish report. It kind of feels like we factored a lot of that in, and it kind of feels like your bigger speculators are more concerned about what the overall economy is going to end up looking like and what our domestic demand is going to end up looking like, and that maybe the supply situation, the short supply situation, which has been known for so long, might end up giving way to a lower demand type situation. Now, the thing I think that was most disconcerting about all that is that, on Monday, throughout the day, we had a lot of strength happening in the stock market. So for the fact that the cattle complex didn't really respond to that, I don't know. That's I'm seeing a lot of flags here, red flags here, Jesse, that are making me a lot more nervous than I was on, say, Wednesday of last week about this the big bull market that we've seen in the cattle complex maybe coming to an end here pretty soon. And I think it's a really good time for producers to be looking at ways to protect that downside.
Well, and you mentioned some of the thoughts there on the outside markets and the economy and the thoughts of inflation coming back in a big way and more. I mean, what are you watching in those macros, energy markets? I mean, what else are you keeping an eye on here as we round out the month, Ted?
Yeah, well, I think you've heard my speech on inflation before, right? There's waves of inflation. In economics courses in college, they touch on this a little bit. The initial wave of inflation comes from raw commodities because demand for products is so high that you need raw commodities to make products. And so the first wave of inflation comes there. The second wave of inflation comes from those products because of having to pay up for higher input costs. And then the third wave of inflation comes from higher wages because people need to be able to pay for these higher products. We keep kind of bouncing sort of back and forth between that second and third wave. They're both in play, I think, at the moment. but it's not that first wave. Like, I don't feel like inflation necessarily means that commodity prices themselves really have to go up sharply. I think we've passed that phase. So yes, inflation is a thing, but my concern on inflation is how the Fed reacts to it. Are we going to see higher interest rates sometime in the relatively near future? And is it going to happen in a climate where you've got other countries of the world, i.e. China, for example, that are really struggling on their economies? So, yeah, no, I've been saying it since like November. Like, I'm really kind of concerned about what happens with the economy over the course of the next year. I think that we are really entrenched in trade wars, and that's going to have an effect not just on our economy, but really everywhere. So I don't know. I really do have a lot of concern about outside market risk to the downside for commodities, for grains in particular, anything that has big export markets. For soybeans, that's half of our balance sheet. For corn, it's been a much corn exports have been a really pleasant surprise over the past 9 months, but that could turn around, in a hurry, given global unrest or global economic concerns and things like that. So, yeah, I mean, to me, that's the big downside risk that we have in these markets. At the same time, like I said earlier, I think there is some reason to be looking at those longer term forecasts and saying, look, those can change, and they do, right? I mean, that can change in a hurry, but maybe if we can get through tariffs and trade and trade wars are quick and easy to win, Jesse, right? If that clears up and we're left with no major damage to the demand side of the equation, and we do start getting into some supply side production concerns, I see that upside too, right? I think anything is possible in these markets over the course of the next year. But my concern has been and continues to be the outside market factors that aren't typical grain things or typical livestock things. I think we have to be mindful of that. We have to look at what happened to corn at the end of February and say, look, something like this could happen again, and be really out of our control. We can have a lot of bullish weather news, but then all of a sudden, bigger picture things trump that. And so, again, lots of risk in these markets. I think it's a great year to be, on top of your game and really protecting, I think, both sides of this.
Ted, if folks want to reach out to you for a conversation there at Zaner Ag Hedge, I know a few ways to get in touch with you. How can folks reach you?
Yeah, Justin, we've got a lot of strategies that we're using to do exactly what I was just talking about. So if you'd like to learn more about that or see how that can work for you, by all means, give me a call. You can reach me directly at 312-277-0113. Aside from that, you can find us on the web at www.zaner.com. You can read a bit about us. You can also sign up for the afternoon commentary that I do, which is like a 5 to 7 minute recap, excuse me, on the grains markets. And then if you're on the Twitter or the X, I am at the Ted Spread.
Ted Seifrin, Zaner Ag Hedge. Always good to hear from you, my friend. Thanks for joining us on the show. Have a good week. We'll talk to you again real soon.
Thanks, Jesse. Thanks for having me, man. And you have a great week too.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.